The Little Book of Common Sense Investing by John C. Bogle is a classic guide to investing that emphasizes simplicity and long-term strategies. Here's a summary. 1. Investing versus speculating. Bogle emphasizes the importance of distinguishing between investing and speculating. Investing involves buying and holding assets for the long term, while speculating involves short-term buying and selling for quick profits. 2. Costs matter. Bogle argues that minimizing costs is crucial for investors. He advocates for low-cost index funds, which track a broad market index and typically have lower fees compared to actively managed funds. 3. Market efficiency. Bogle believes in the efficient market hypothesis, which suggests that it's difficult to consistently beat the market. Instead of trying to outsmart the market, he recommends investing in the entire market through index funds. 4. Long-term focus. Bogle encourages investors to adopt a long-term perspective and avoid trying to time the market. He emphasizes the importance of staying disciplined and patient, especially during market downturns. 5. Diversification. Bogle emphasizes the importance of diversification in reducing risk. By spreading investments across different asset classes and geographic regions, investors can mitigate the impact of any single investment performing poorly. 6. Stay the course. Bogle advises investors to stay committed to their investment strategy, regardless of short-term market fluctuations. He warns against reacting emotionally to market volatility and encourages investors to focus on their long-term goals. Overall, The Little Book of Common Sense Investing promotes a simple yet effective approach to investing based on low-cost index funds, long-term focus, and diversification. Bogle's principles have become foundational for many individual investors and financial professionals alike.